Welcome back to Charting Essentials, the show where we talk about everything technical analysis. Today I want to take you back to school. Don't boo me. We're going to talk about some geometry. So in previous sessions, we've looked at a lot of price action. We looked at reversal patterns. We looked at the head and shoulders and how that shows a market that's moving from an uptrend into a new downtrend. And we looked at an inverse head and shoulders, which shows us a market that's moving from a downtrend into a new uptrend. Today I want to move away from that. I want to talk about continuation patterns. So what is a continuation pattern? It's a pattern that emerges after a trend, and it suggests that that trend is setting up to continue in the same direction. So when we talk about a triangle consolidation or triangle pattern, which looks like this, ideally to draw this pattern, you need to have two resistance points and two support points to link. You'll see they'll taper towards a central point or an apex, and that is your triangle. So if you see this pattern after an uptrend, the suggestion is that uptrend is going to extend. If you see that pattern after a downtrend, it's a suggestion that that downtrend is going to extend lower. If you're trading this pattern, what you're going to do is you're going to wait. You're going to wait for a breakout. You're going to see that price breaking out in the same direction as the previous trend. That would be your confirmation signal. To give yourself an upside target, we use that theory of proportion again, which means that we measure the height of that consolidation, the height of the pattern. We project that same height from the breakout point to project our target. This can be in an uptrend or a downtrend. The chart patterns are actually something that I subscribe to in trading. When I look at it, the logic of it, when I look at a triangle formation, to me it's showing that the market's been in a trend. It's have a brief pause in that trend. It's just catching its breath before it gets going again. If you want to be fancy, quite often to identify a consolidation, like a triangle consolidation, you could add something like volume. You'll quite often see when the market's taking that breather, you'll see volume just start to taper off. The volume levels start to get lower. And ideally, if you're looking for the breakout side of things, the pushes above resistance in an uptrend or pushes below support in a downtrend, you would like to see that breakout accompanied with a spike in volume, a higher volume, showing that there's a lot of traders committed to that directional move. So in trading, when we look at these chart patterns with head and shoulders and triangles or whatever they are, I think you really just need to be able to separate what is trend and what is consolidation. When is the market in a direction, when is it not? Consolidations often come after trends. They give us a clue as to what the next move might be. If I look at reversal patterns versus continuation patterns, what is my preference to trade? I do prefer to trade continuation patterns. I think that sort of inertia to a directional move is easier to follow than what can be quite a noisy change in trend direction when you look at a reversal pattern. I still think they're both relevant, but it is just my preference to trade continuations rather than reversals, but use reversals as warnings that when maybe exit signals for trades. One of the core concepts in technical analysis is saying that patterns reoccur in markets, and they really do. You're going to see triangles all over the place. You just got to learn to spot them. I think it's a very, very useful trading tool, and you can certainly add other technical analysis indicators to support decisions. So go check it out for yourself. Thank you very much for joining. I'm Shaun Murison, Senior Market Analyst at IG.